Right. Question 5, Companies Act, financial statements, and then also a little bit of auditing questions, where this is the answer book. We're asked to do the income statement, and they've already given us the format of the income statement, which is great. You should know this off by heart, and this is for the year ended 28th February 2014. Sales, cost of sales, etc. We're given the other operating income, and we're given the net profit after tax, so we may have to use that. Then 5.2.1, we're asked to do the trade and other receivables for 7 marks. 2.2, ordinary share capital for 9 marks. Retained income note for 8 marks. And the balance sheet as at 28th February, and they've already given us the format here, very generous of them, for 23 marks. And then we've got a couple of theory questions for 10 marks. Total of 70 marks. We've got 70 marks. That gives us 70 times 0.6. That gives us 40 minutes. Actually, that gives us 42 minutes if you're doing the calculation yourself. Here is our question. Champions Limited, a public company with authorized share capital of 750,000 shares. Remember, authorized shares is the number of shares that they are allowed to issue. That's not necessarily the number that is in issue currently, but that's how many shares they are allowed to issue. Alright, the information relates to the financial year ended 28th February, so our year goes from, if it ends on 28th February 2014, when does it start? It starts on 1 year ago, which would be 1 March 2013. Always good to have a timeline, right? 5.1 says, fill in the missing amounts on the income statement provided. Note, point F has been taken into account in calculating the net profit after income tax of 320,000 Rand. Then we're also asked to do the balance sheet, so we can just remember that, or the notes to the balance sheet, as well as the balance sheet. So as we go through the additional information, we can take account of everything that relates to receivables, share capital, retained income, and know that we're going to have to deal with that specifically. Alright, and then we've got our couple of theory questions, 5.4 and 5.5. Our additional information gives us a pre-adjustment trial balance on 28th February. So that's, in other words, before any adjustments have been made. Remember, we've got pre-adjustment trial balance, then we've got our adjustments. Sorry about that. Then we do our adjustments. Then we've got our post-adjustment trial balance. Then we do our closing transfers, where we take all our incomes and expenses and we move them into equity, into retained income. And then we've got our post-closing trial balance, which would not have any incomes and expenses. But we're here at the pre-adjustment phase, so we may still have to do some adjustments. Okay, so that we've got, we'll go down just a little bit. Additional information, share capital, so we know we'll deal with this when we do our share capital note. The business also bought back some ordinary shares. At this stage, we're just doing the income statement, 5.1. Alright, so for the income statement, the share capital and the share buyback is not going to have any effect, but we know we're going to deal with this later when we do those notes. The loan statement, alright, this may be relevant. The loan statement received from Century Bank showed the following. Opening balance of 278,800. Just have a look here quickly. Okay, this should actually have said your pre-adjustment trial balance says loan from ABC Bank, and your additional information should also have said ABC Bank, because it's the same bank that they're referring to, the same loan. Alright, Opening balance is 278,000. Then we've made some repayments, and the closing balance comes to 187. Let's quickly put this in our calculator. We've got a point here that says provide for interest on the loan. That means they have not yet provided for the interest on the loan. And then 35,000 Rand of the loan will be paid in the next financial year. Why is this piece of information important? It relates to the next financial year. Okay, this is important when we're doing our balance sheet and we have to split out our liabilities between current liabilities and non-current liabilities. Whatever we pay next year will be current liability. Whatever we don't pay next year will be a non-current liability. Okay, so let's quickly see if we can calculate the interest. They say provide for the interest, so that's obviously not yet included. And let's have a look. Just want to add a page. Right, so we're given an opening balance of 278,800. So loan opening balance is 278,800. Then we're told that the repayment during the year, including interest, is 108,800. So our movement, what will cause a movement in the loan balance? Any repayments that we make is going to cause the loan balance to decrease. What if they charge interest? Interest is going to cause the loan balance to increase. Right. So that will be an increase. Any other movements that we may have? If we take out an additional loan, that would increase again the loan. And if we repay, we've already got that in. And then we've got our loan closing balance. Right. Then we're told that our net repayments is 108,800. So that's going to decrease the amount that we owe. And our closing balance is 187,000. All right. So now our question is, what is our interest? And a simple balancing figure that you need to calculate. So simple mathematics. All right. 278,800 plus, so not plus, minus 108,800 plus the interest is giving you 187,000. Happy with that? So now we're looking to calculate the interest. So you just need to get interest on its own. Move everything to the other side. Right, so whatever we do on the left hand side, we need to do on the right hand side. If you take these two figures, you minus that one, you're going to get 170,000 plus the interest is equal to 187,000 minus 170,000 on both sides. Then we're going to get interest is equal to 187 minus 170,000, and therefore it's going to leave me with 17,000 Rand. Now what do we do with this interest? They say provide for the interest on the loan. Okay, so we've got one of two options. Depends whether the interest is capitalized or not. Right? In this example, they didn't specify that. So we're going to say assume the interest is capitalized. Assume capitalized. The reason for that is that the loan statement received from the bank shows 187,000 Rand. If you simply accrued for the interest separately, that would not necessarily be incorrect because they didn't specifically stipulate that. But because the loan statement says 187,000 Rand, we're also going to capitalize this interest to form part of the amount that we owe to ABC Bank. Right, so what will our entry be if we capitalize this? What do we debit? What do we credit? We need to increase our interest expense by 17,000 Rand, and we need to increase the loan amount by 17,000 Rand. Okay, alternatively, if it was not capitalized, what you would do is you would say assume not capitalized sorry, this is a spelling mistake. Capitalized. Then we would debit interest expense. And which account would we credit? What?
Expense bill.
Expense payable, yes. Expense payable, also known as accrued expense or expense payable. Same thing. Okay. So you really could have done either one of those, depending on what you assumed, whether the interest should be capitalized or not. Remember, if it's a mortgage loan, that you should always capitalize the interest. Okay, but in this case, it depends on the agreement. It wasn't exactly specified what the agreement says, but the loan statement, however, indicates that the interest is part of the closing balance, and therefore we also capitalized the interest. Right, so is this going to affect the income statement? Any of these two entries going to affect the income statements? Yes, the interest expense is going to affect the income statement. This will affect my balance sheet, right? But the interest expense is going to affect the income statement. So I go to the income statement, I look at interest expense, and I know I need to add 17,000 Rand because they specifically told me provide for the interest. So there we go, 17,000 Rand in there. And we're putting it in brackets here, just so that if there's any additional amounts, we can add that as well. Again, you can refer yourself back to your calculations, right? Calculation 1. And make sure you're doing a cross-referencing calculation 1 so that the examiner can know that you made a calculation. Always ask for a separate answer sheet and do your calculations there if there's not enough space on the answer book. Okay, otherwise you can do it on the answer book. Right, that was the interest expense. Right, so we've dealt with the income statement portion here, we've dealt with that. This we know is going to affect our balance sheet split between current liabilities and non-current liabilities. Then we know the income tax for the year was calculated as 124,000 Rand. This must be taken into account. So where do we need to take it into account? In the income statement. Where else? And the balance sheet, yes. And it may affect our notes. Okay, because we're asked for the trade and other receivables note. So if SAR's account ends up being a receivable, it's going to affect our notes as well. Okay, so just need to remember to deal with that. Income statement, balance sheet, and notes. Right, so let's deal with the income statement for now. The 124,000 Rand, that's going to affect my income statement here. What is it going to do to my incomes? It's going to reduce it, so therefore we indicate that with a bracket. Happy with that? Good. Then, a final dividend of 25 cents per share was declared on 28 February 2014. This must be taken into account. So what does this affect? Definitely affects the balance sheet. Where does it affect the balance sheet?
In the
Equity and liabilities, yes. Equity, because my retained income is going to be decreasing, right? Retained income goes down because of the dividends. And my liability, shareholders for dividends, is going to go up. Okay, brilliant. And it's 25 cents per share, so we're going to need the information of our shares here at the top in order to calculate that. But right now for the income statement, it doesn't affect our income statement. Obviously, it will also then affect the retained income note. Okay, because we were specifically asked to do the retained income note. Right, so nothing yet for our income statement. Then number F, the following adjustments must be considered for the balance sheet only. So we know it doesn't affect the income statement. Right, and we also were told that point F has been taken into account in calculating the net profit after income tax of 320. So this point F we can actually ignore for the income statement. This is going to be for the balance sheet and the notes. Right, then let's go to, we can just quickly read it. It's got information about the rent, insurance, provision for bad debts, and audit fees. Okay, and all of this has been taken into account in the income statement. Point number G, the following financial indicators were calculated at the end of the year. Operating profit margin is 10%. Now here it's important that you know your ratios. Okay, so what is operating profit margin? It is my operating profit over my, if you don't know this, you'll not know what to do with this information. Okay, operating profit multiplied by 100, and that's going to give me, in this case, 10%. Okay, that we know, and we also know the gross profit over my, whenever you see the word margin, you should know it's something over sales. Gross profit percentage, or gross profit margin, gross profit over sales, times 100, that is 60. Right. So now, what do we have in our income statement? Let's have a look. That's really all we've got. Okay, we've got the 124. If our net profit after tax is 320, our income tax is 124, what is my net profit before the income tax? I simply have to add this back. So I can say 320 plus 124, and that's going to give me 444,000. Okay, don't do those abbreviations. So let's just do this. 320,000 plus 124,000. Show your calculations. Right, then we know that there's no more interest expense. So what do we do with interest expense in the income statement? Add or subtract? We're going to subtract that, 17,000 Rand. So what is my net profit before interest expense? Right, so my net profit before interest expense is then going to be the 444,000 plus the 17,000, and that's going to give me the 461,000. You can always check yourself by simply doing the calculation. You say 461 minus 17, you should get back to 444. Right, next one. Now we don't know what my interest income is, or do we? Do we know what it is? Was it not given? No, it wasn't given. So let's have a look at our information again. We know the operating profit margin is 10%, right? So that means operating profit over sales times 100 is going to give me 10%. We do not have the sales figure, we do not have the operating profit figure, or do we? We've got the other income figure, but we do not have the gross profit figure, and we also don't have the operating profit figure. So if we look at our pre-adjustment trial balance, have a look there, see if we find any incomes and expenses in here, and we see that rent income of 16,400, interest on fixed deposit is 10,000, and total other operating income is 50,000. Right, so we can record interest income as 10,000. We got that from the pre-adjustment trial balance. Right, now we can calculate actually our operating profit. So quickly calculate your operating profit. Have a look here. Your net profit before interest expense is your operating profit plus your interest income. So what is the operating profit? Yes, it's going to be 451,000. How do we get that? It's the 461,000 minus the 10,000. Remember, all of these are subtotals. Have a look here quickly. This is a subtotal. This is a subtotal. This, in this example, is a subtotal because we're not given a list of all the expenses. Operating profit will be a subtotal. This will again be a subtotal. That's a line item. This is another subtotal. So many subtotals. Okay. So only these couple of line items here. This was given to us. There it is. This one we had to get from the pre-adjustment trial balance. Interest expense we got from the additional information. Net profit before tax was simply a subtotal calculation. Income tax was given to us in the additional information. So really all of this was given to us. And the rest was just subtotal. So this was 13 marks given away. Alright, now that we know the operating profit, and we know that the operating profit margin is 10%, we can actually work out our sales figure. Okay, so we can refer ourselves to a calculation again. So let's just make space here. Let's calculate our sales figure. So we're going to calculate our sales figure, and this is going to be calculation 2. So we refer ourselves here to calculation number 2. Let's just grab this here. I wonder if this will work. We can just take this. That didn't work. Alright, let's go back here. We know operating profit over sales is going to give me 10%. Right. So if we simplify this further, we know that. Right. So if we simplify this further, then we have divide both sides by 100. This becomes 1, and this becomes 10 over 100. All right. So then we've got operating profit over sales, then becomes 10 divided by 100 is 0,1. We know what our operating profit figure is. What is it? We just calculated that. Here it is, 451,000. So we go back to our calculation. The top of the line becomes 451,000 over sales equals 0,1. So then it's simple. We just find sales all by itself, and then you've got sales. You can put your finger on sales, and then you're left with 451 over 0,1. Okay, that's the triangle. And if you remember the triangle, so if you've got 451 at the top, sales here, and 0,1, you can calculate any one of the other ones. Put your finger on sales, then you know the answer is going to be 451 over 0,1. Otherwise, you can you can do the long method where you say, all right, let's multiply both sides by sales. We got sales there, sales there. This then cancels out with this. So we've got 451,000 equals 0,1 sales. Right? Then we divide both sides by 0,1. So this over 0,1 and this over 0,1. And then we've got exactly what we have here. Sales equals 451 over 0,1. So sales is going to be 4510,000. As easy as that. So that's your sales figure. 4510000. Alright, so we only need a few figures still. We only need our gross profit, cost of sales, gross income, and operating expenses. But we know, what do we know? We know that the gross profit margin is 60%. That was given to us. Alright, so we can do the same thing. We can substitute what we have. This time we've got the sales and we're just going to need the gross profit. So let's do that. Let's just open up another calculation here. Calculation number 3. And what we're going to calculate now is cost of sales and gross profit. Right. So, first thing, we know that the gross profit margin over sales is equal to 0,6. Okay. So now we've got the sales, so we know that the gross profit over 4510 equals 0,6. So gross profit, simply going to calculate as the missing figure. Therefore, gross profit is equal to 4510 multiplied by 0,6, and you're going to get the answer of 2706000. The key is here that every piece of information given, not always, but most of the time, the information is given for a reason. Okay, so you need to, if you haven't done anything with the information given, you need to ask yourself, is this irrelevant or have I missed something? And oftentimes, just by writing down what the formula actually says, you can see how the information can be useful. Then you know, oh, but I've got my operating profit now, and I only need sales. So I can then, if I've only got one missing figure, I can actually find it. Right. Basic mathematics. Right, now we've got the gross profit, 2706, so let's fill that in. If my gross profit is 2,706, my sales is 4.5 million. What is my cost of sales? It's going to be the sales figure minus the gross profit figure. Therefore, it's 4510000 minus 2706000. You're all comfortable with that? Rabo? Good. So then we're going to get what? Yes. 1804123. Remember? Gross profit is sales minus cost of sales. So don't forget your brackets. Right, that should give you your gross profit. Then we've got the gross profit. Have a look here. Got the gross profit. Got this figure was given to us. So we can calculate our next subtotal, which is simply the gross profit plus the other operating income. So calculate that. Right, so that is 2756123. And then we only need one more figure. One missing figure here is our operating expenses. We've got the other two figures. We've got gross income and we've got operating profit. So how are we going to get from gross income to operating profit? See if we can calculate the operating expenses, which will be my balancing figure. What are we going to do with operating expenses? Add or subtract? Okay, so let's quickly see if we can calculate your balancing figure for operating expenses. And that is correct. Final answer is then 2756123 minus my operating profit. That's going to give me 2305123. Okay, remember gross income. If you're not sure how to calculate that, just write the formula for yourself as to how to get to the subtotals. Gross income minus operating expenses is equal to operating profit. And we are looking for the operating expenses figure. So we need to get this one all by itself. So we add operating expenses on both sides. We've got gross income plus 0 equals operating profit plus operating expenses. We need operating expenses on its own, so we take this one to that side, subtract it on both sides. Gross income minus operating profit equals operating expenses. And that's why we say gross income minus operating expenses. Okay, so if you write down the formula, then you can never really go wrong. Right, and that is my income statement. There was actually 13 very easy marks. You just needed to know the format and how to calculate your subtotals. And that is nothing but money for jam. Right. Right, now with a question like this, there's two ways that you can approach it. You can either say, let's tackle each one of the required sections on its own, but that may mean that every time you read through a required, you have to look at everything of the information again. You have to read through everything. And you may, as you get to know the question, you may learn that, okay, this is not applicable here. Like for example, share capital and the buyback, that's not applicable for the income statement. But another way that you can follow is to say, let's tackle all the information given and make sure we deal with all of it as we progress. Okay, so let's follow that approach. Let's start with the extract of the pre-adjustment trial balance. We know we're asked to do the notes, income statement and the balance sheet. Well, we've already done the income statement, so we just need the notes, specifically the share capital one, the retained income and the trade and other receivables. So those are the notes we're looking for, and we need to do the balance sheet. So if it's a liability, asset or equity account, it's going to affect the balance sheet. Okie dokie. So the first amount we've got in the trial balance is our share capital of 2.4 million. Right, so that's going to affect my balance sheet, but also my notes. And this is the pre-adjustment trial balance. But we know that there was additional information on share capital, so let's read that. There was 400,000 shares that were in issue on 1 May 2013. Now this again should have been 1 March 2013, but it didn't make a big difference to the answer. That is the beginning of the financial year. Okay, so we can put that into our notes. So if we go to our notes, we know that our ordinary share capital note, we have to start off with the number of shares that is in issue is 400,000 ordinary shares on 1 March 2013. No. You don't put that in the actual ordinary share capital. Let's put that in. Karaba has just reminded me that we have to start off with our authorized shares first. Okay. So this note given, there wasn't enough space for that, and there wasn't any marks awarded for that, but the number of authorized shares were 750 right at the beginning. That was given to us. Okay, so that's 100% correct. 750,000 authorized shares for this company. Authorized ordinary shares. Then we've got the actual shares that was issued. Alright, and then we start with the opening balance. We know that there's 400,000 ordinary shares, and the total for that was 2.4 million. Right, let's go here. Then 200, sorry, that's not correct. we don't know yet what this total is. We have to calculate that. We know that there was 400,000 shares on the 1st of March at the beginning of the year. There was 200,000 additional shares issued on 31 October. So here's our financial year. 1 March, 31 October, and then 28 Feb. Before any adjustments, we know that the balance is 2.4 million, yeah. But we don't know what this amount is, and we don't know what this amount is. Okay. Now they tell us on 31 October at 4.50, 200,000 shares were issued. So how much share capital did we raise on 31 October? 4.50 times 200, and that gives me 900,000 rand. Okay, so we can fill in that we issued 200,000 shares. There we go. And we know this is going to be 900,000. Now we also know that these two together gives me 2.4 million. So we know that this figure is going to be, we can simply put here a star calculation, let's say calculation A, and that is going to be, refer yourself here to calculation A, and that's going to be 2.4 million. Yes, minus the 900,000, and that's going to give me 1.5 million. Perfect. Happiness. Right, so now we've dealt with this piece of information and we've dealt with that piece of information. So 2.A, we can tick that off. Then on 31 January, that's about here. So you see the timeline helps you to see the picture. On 31 January, around about here, the business bought back 25,000 ordinary shares for 95,000 rand. This transaction was not taken into account in the pre-adjustment trial balance. Okay, so every transaction in accounting needs to have a debit and a credit. So where's my debit and credit leg going to be? Which two accounts are affected here? We bought back for 95,000 rand. So what's happening to my cash?
You increase the bank.
Bank is going to go down, and then my equity needs to go down. And you will remember that equity goes down on the debit side, bank goes down on the credit side. Exactly. But now we need to know which equity account is going to decrease. Is it equity? Is it share capital? Or is it retained income? Share capital or retained income. And how will we know that? We need to calculate the average issue price, because that's going to tell us everything above the average issue price, needs to be reducing retained income. Everything below or equal to the average issue price needs to go off share capital. Okay, that's very important for your buyback. So let's have a look here. Let's add another page here, or let's just go to the top. Let's calculate our average issue price. What is our average issue price here? How do we calculate that?
You add the issue shares times the additional shares.
Yes, you take your total share capital, over your issued total shares in issue, and that's going to be 2.4. That's before the buyback, average issue price before the buyback. Right, 2.4 over total shares in issue is 600. Right, so if you divide that, you're going to get an answer of 4 Rand. Right, now we bought back. How many shares did we buy back? They say we bought back 25,000 shares at a price we don't know, and the total gave us 95,000 Rand. So how am I going to calculate the buyback price? Buyback price is going to be equal to, right, so then we can calculate our buyback price by taking the total buyback price, 95,000 Rand, divided by 25,000 shares, and that's going to give me 3 Rand 80 per share. Right, now how is this important? We know the average issue price is 4 Rand. We know the buyback price per share was 3 Rand 80. We know that everything that is above the average issue price needs to reduce my retained income. And everything that is below or equal to the average issue price needs to reduce the share capital. Okay, that makes sense. Alright, because we can only take out of share capital what is in share capital. And everything that went into share capital effectively went in there at the, we can say it effectively went in there at the average price of 4 Rand. Right, so we cannot take out more of share capital than what went in there. So that's why we limited it to the average issue price. So in this case, the whole buyback price is below or equal to the average issue price. So everything is going to go from my share capital. So this was actually an easy one, but it may have not been like this. And if it wasn't, there would be a lot of marks allocated for doing these calculations. Okay, just for interest's sake, if you're asked to do the cash flow statement, which amount would you show as the amount paid for the buyback?
For me,
Sorry?
380.
Now, which total amount would you show on the cash flow statement?
The 95.
The 95 would be the cash inflow or outflow?
Outflow.
Outflow, because you're buying back the shares. Okay, and almost guaranteed that a buyback of shares will come up in your end exam, because this is a new topic for 2014. So important that you know this really well. Okay, know the different variations. Okay, so this was 3 Rand 80. So in this case, everything is coming from share capital. So that means we can take the whole 95,000 and subtract it from our share capital. And we fill in our details here. The number of shares purchased was, or repurchased, is 25,000. We can put that in brackets to indicate that it's a negative. And that is ordinary shares bought back. And we can write in brackets here, average issue price is 4 Rand. Okay, it was bought back at 3 Rand 80 per share, but the average issue price was 4 Rand. Okay, so there's not enough space here in this particular answer book, but that doesn't matter. And then you can always put your total down here at the bottom. And we simply have to total that and total these three. And if we do that, we're going to get 575,000 ordinary shares on 28 February. And if we total this, we'll get 2305,123. Remember, you can see here that the buyback actually decreased the share capital. When we issue shares, what happens? My bank is going to go up because I'm actually getting money. Okay? Issuing shares is a way for the entity to get finance. So the bank is going to increase and my share capital is going to decrease. Sorry, not decrease. It's going to increase as well. Right, so bank will be debited because it's increased. Share capital is going to be credited. Right, now when I buy back, it's going to be the exact opposite. Bank, we're going to give out money, we're going to buy back the shares, and our share capital is going to decrease. Why would an entity buy back shares again? There's a number of reasons. If the shares are owned by multiple people, so let's say, let me see if I can find a blank piece of paper here. Let's say we've got 3 owners here and they each have a number of shares in the company, and this guy has got 1, 2, 3, and they actually want to take away the ownership from this guy. They will buy his shares back and somebody else can perhaps take them up. So that's a way for the company to change the ownership or the control of the business. Another thing, what a share buyback does is have a look here at the number of shares in issue at the end of the year. After the buyback, there is less shares in issue. All right. So what's that going to do to my earnings per share and my dividends per share calculations? Because earnings per share is net profit earnings over number of shares. And if the figure below the line has decreased, what's going to happen to my earnings per share? It's going to increase. Okay, so it's just a way to make the financial statements look a little bit better. Okay, but there's a number of other practical reasons if you refer back to your notes. Okay. Also, if there's too many shares in the market and the market price of those shares will probably be low, so it's a way again, market price per share, same story. If you've got less shares in issue, market price, total market price over the number of the shares. If you reduce the number of the shares, what's going to happen to this answer? It's going to increase. Okay, so it's a way just to make the market price of the share look better. Okay, so remember that because you might get theory questions on those. Let's go back to our information. We were actually busy going systematically through our information and we got a little bit stuck on our additional information here on shares. So let's go back to our trial balance. We've now dealt with the ordinary share capital. We can skip the trial balance for now and come back to it as we deal with the other information. And the loan statement. Let's deal with the loan statement for now. We know that the loan has a closing balance of 187,000 Rand. That includes the interest as capitalized interest. Alright, where is this going to go? That's going to go in my balance sheet. Okay, so I can go to my balance sheet and under non-current liabilities I can put the loan from ABC Bank, and I need to take into account that 35,000 Rand of the loan of 187,000 Rand will be repaid next year. Okay, so my loan is effectively, you remember we said previously, where is it now? It's a little bit down. It's further up here. Here we had our loan. We said the loan closing balance is 187,000 Rand. That was the capital amount plus the capitalized interest. We assume that we capitalized the interest. So therefore we've got the, let's go back to the balance sheet. We've got the capital amount of 170 plus the capitalized interest of 17,000, or you can just have the amount from the loan statement, 187,000. Right, but we need to remember that 35,000 Rand of this is going to be repaid in the next year. So that's going to be a current portion. So we need to subtract it from the non-current portion. And we need to add that to our current liabilities. And we're going to write here short-term portion of the loan. That's going to be 35,000 Rand. Happiness. Okie dokie. Now that we've got that. Right, so that is our loan. So let's go back to our information. We're done with the loan. We've done the balance sheet and the notes. There was no note asked for the loan. So we're good with that. We've dealt with both these two pieces of information. Income tax for the year was 124. This must be taken into account. All right. So now, where is this going to have an effect? Let's first look at our trial balance and see what we have. Our trial balance shows that our income tax provisional payments is 114,000. So that's an asset. That means we've paid tax in advance provisionally. Now, we're saying, okay, our income tax liability for the year is 124,000. So the situation looks as follows. If we drop our SARS T account, it's going to look something like this. We currently have an asset of 114,000 from my provisional payments. Now, when the income tax liability comes through, on which side is that going to go?
The credit side.
It's going to go on the credit side because it's going to increase the amount that we owe to SARS. Right, and my details will be income tax. This is somewhere a quick revision of company transactions. Income tax expense. Right, so what is this account now? Is it now an asset or a liability?
Liability.
Why is it a liability?
Because you owe.
Because my credits are more than my debits, so we actually owe more than we have paid. Exactly. So this is going to be a liability of how much? If you calculate this balance, it's going to be 124 minus 114. That's going to be a liability of 10,000 Rand. So, since this is a liability, where should we disclose it in our income statement? In our balance sheet. Needs to go under liabilities, current liabilities, and it will form part of my trade and other payables. Again, important. That includes your SARS. Yeah, just remember here quickly your trade and other payables notes. It includes your trade creditors. It includes expenses accrued, income received in advance. Shareholders for dividends can be included here, or it can be disclosed separately. SARS income tax, which is the one we just included now, the 10,000, and then all your salary liabilities. Salary control accounts, amount you owe to your employees, to the UIF, to pension funds, or medical aid. And if we just go up a little bit here, I just want to show you the trade and other receivables note. It's got your net trade debtors, which is your trade debtors minus provision for bad debts. Your SARS account if it is an asset, right? But in our case, it's a liability, prepaid expenses, and your accrued incomes. Right, so in this case it's a liability, so we can just refer ourselves here to calculation B. Just make sure you're writing that down. Calculation B, 10,000. Okay, you can do the calculations whichever way you like. If you want to do T account, or if you want to do it just with the normal calculations, whatever you prefer. Alright, so we've dealt with this 114,000 Rand here. let's go back to the additional information. We've got this in the income statement already. We just put it in the balance sheet, and it's already in the notes. There's one other place that we have to show the... No, I'm lying. That's it. Right, then information number E. A final dividend of 25 cents per share was declared. Okay, if it's declared, have we paid it yet? Not necessarily. They don't mention anything about payment, so if we haven't paid it, that means we have an obligation to pay it, so we owe this. So this is going to form part of my liabilities. Right. In the balance sheet, it will form part of my liabilities, and it's also in the balance sheet going to reduce my retained income. And I was asked to do the retained income note. Okay, so let's go back to our answer book, and somewhere where we've got a blank page, we're just going to do a quick calculation. Can you see why I encourage you to ask for a separate answer book? Because you always want to be writing something down that you can refer to so that the marker can refer to that. Okay, so here we go. Information says that 25 cents per share on 28 February. So how many shares were there in issue on 28 February? Exactly. 575, which we've already calculated there in 5.2.2. So we're going to use that. Just want to go down here. So let's call this calculation, I don't know where we are now, calculation C. And this is busy calculating the dividends declared. Just write down exactly what you're calculating, and it is, I keep forgetting how many cents, 25 cents per share, 0.25. There was 575,000 shares. That's going to give me a total of
943,750.
Exactly. And what are we going to do with this? The debit goes to ordinary dividends. The credit goes to shareholders for dividends. This amount here, ordinary dividends, this is going to be disclosed as part of the notes under retained income note. And the shareholders for dividends is going to be disclosed in the balance sheet under my current liabilities. You can disclose it separately, or you can do it as part of trade and other payables. Right, so we've already done our calculation here, 143750. So we can now just go and fill that in, plus 143750. And we refer to our calculation, very important. Calculation C. Okay, so that's exam technique, very valuable. So that if you, by some chance, maybe you said 0.25 times 600,000 Rand, perhaps the marker is generous and will give you 1 mark just for getting the principle correct. Okay. Now we've done the one part. We've disclosed this in the balance sheet under trade and other payables. We need to now just disclose this under our retained income note. Okay, so let's go to our retained income note. Got an opening balance of 244,000. Where did they get that from? That was in the pre-adjustment trial balance, 244,000 Rand. Okay, so that's already been included. Okay, then we know what do we need to add to retained income. Retained income increases with our profit that we make. Net profit Here is our retained income note. So this you should know off by heart. The net profit after tax for the year, which was given to us in this question as 320,000. Right? And if it wasn't given, you'd have to calculate that. And that might be a whole number of marks, but there it is. 320,000 Rand. Okay. And then we need to record any repurchase that was taken off retained income. But in this case, all the repurchases went off share capital. So that's not necessary here. So we can leave that one out. And then lastly, our retained income is going to be decreased by any dividends. And we need to split that between the paid and the recommended, which is the same as declared. Okay, so we're going to have here ordinary dividends. And we're going to have interim dividends paid and final dividends. Sorry, I'm abbreviating here, please don't do that. Declared. And this again is from calculation C 143750. Do we know what our interim dividends paid is? Right, we're going to start looking at our information. First place we're going to look is the pre-adjustment trial balance. We go through the list, and there we go, right at the bottom there, ordinary share dividends paid on the 31st of August. That's in the middle of the year. Slap bang, 144,000. So we can fill that in. Interim dividends paid, 144,000. Okay, and just because you know the format of the retained income note, you're going to be able to score another mark because you need to now add up these two dividends amounts to give you the total dividends on ordinary shares. So if you add up these two figures, you can take a calculator and calculate that, and you're going to get 0.57782. That's again just by knowing the format. Mahala. Right. Then what is our dividends going to do to the retained income figure? Increase or decrease? Decrease. So whenever a figure decreases another figure, we need to put that in brackets. So if we total our opening balance plus our profit minus our dividends, we're going to get our final retained income balance of 276,250. And where do we take that? Yes, this is going to go to the face of the balance sheet. Under the equity section, under shareholders' equity, we're going to have ordinary share capital, and we're going to have retained income. By the way, you can fill in this format before you even start the question. You can fill out the full format of this balance sheet. We'll do that now. Retained income then is 276,250. Does it increase or decrease equity? Retained income. It's going to increase the equity of the entity. That literally shows you how much of the profits have been retained in the entity over all the years, how much of the profits have been retained, and it's going to increase the net worth of the business, which is found in your shareholders' equity.
Can you find the ordinary share capital?
We've also already found the ordinary share capital, so we can go and get that from our note. It was 2,305,000. Right. Good. Now we can go back to our information, what were we busy doing? We were busy going through the additional information here. So we've dealt with point number E, and now we're getting to point number F with another few adjustments, right, which makes sense because we kind of expected that because we were given the pre-adjustment trial balance. So we kind of expected there to be some adjustments. So whatever we see in the pre-adjustment trial balance is not actually the true picture. So we need to adjust this so that it reflects the true picture. So we're going to take them one by one. The rent for February 2014 was not yet received. The vacant storage space was rented out since 1 December 2013. So let's draw our timeline here. Let's go to a blank page here. Right. So we know this vacant storage space. Here's our financial year. 1 March 2013. The year end is 28 February 2014. It's been rented out. This would be 1 Feb. This would be 1 Jan. It's been rented out since 1 December. So that is 1, 2, 3 months that we've rented this out. Information says the rent for February was not yet received. Okay. So this month is still outstanding. So that is income that we have not yet received. So what is the adjustment that we need to make? Okay, so let's look at our situation. We've got a vacant storage space here. There it is. And we're renting this out. Now let's look at what our pre-adjustment trial balance says about rent income. It says we've got rent income of 16,400. So pre-adjustment trial balance says rent income is 16,400. How many months rent does this represent? So we've rented out the space and we've received, or the trial balance shows that we've received 16,400. We've rented it out for 3 months, okay, but we've only received 2 months. So this is the rent for 2 months. So if we want the rent for 1 month, we need to divide this by 2. That's going to give us 8,200. Right. And this is the rent that we still need to receive. Exactly. Right. We've earned it. We've rented out the space for 3 months. We've only received 2 months. This we've received, but we've rented it out for all 3 months. Okay. There we go. Rented out, rented out, rented out. We've only received 2 months. So we've earned it, but we simply haven't received it. So we need to adjust our books to show what we've earned. Okay, that is the accrual principle, which says it doesn't matter how much cash you receive. It's really all about how much you've earned or how much you've incurred. So we've earned income for 3 months. We've only received income for 2 months, but we've earned all 3 months. So we need to make our adjustment. So what are we going to do? Our rent income needs to increase. Okay, so how are we going to increase our rent income? On which side does an income increase? We need to credit. Okay, this should be very much second nature by now. So rent income is going to be credited by 8,200 Rand because there's 1 month's rent that we need. And what are we going to debit? This money is being owed to us. Remember, we rented it out to someone, right? But they just haven't paid us. So they owe us money. And that we're going to call accrued income. All right. It's going to be an increase. Is accrued income an asset or a liability? It's an asset because they owe us money. Right. So, where are we going to disclose this information? The rent income goes to the income statement, right? But we've already done the income statement and they gave us all the figures there and they said these adjustments have been taken into account already. Point F has been taken into account in calculating the net profit. Okay?
Other receivables.
Exactly. Now it's going to be the accrued income, 8,200. It's going to be part of my assets under current assets. Why is it a current asset? Because we're hoping that we're going to get this 8,200 Rand within the next 12 months. So that's why it's a current asset. So we go to our balance sheet, and we were actually asked to do the trade and other receivables note. So we can go to that note and we can fill in accrued incomes of 8,200 Rand. I'm starting here at the bottom because if you know the format of the trade and other receivables note, you will know that you need to record the provision for bad debts, okay, and then the net effect of the debtor's control and the provision for bad debts is going to give you the net trade debtors. And we also know what else forms part of the trade and other receivables note. Possibly the SARS account, but we've already ruled that one out because it's part of the liabilities. Okay, so we're not having that one. What else? Our prepaid expenses. Okay, so we know we're looking for these, and we know we've already found one of them, accrued income, 8,200, and that was calculation. We need to refer to that calculation. Calculation D. Let's go down. Here we go. Oh, that's horrible. Calculation D. Okay. Easy. We're almost there. Okay, let's go back to our information. We're done with the first one, the rent. We've accrued for the income. The next one here, an additional insurance policy on plant and equipment was taken out on 1 October 2013. The annual premium of 8,880 has been paid. So again, we're going to draw our timeline. And we will that's going to be calculation E, right? So we've taken out an additional insurance policy. There's my financial year, 1 March, 28 February. We took out this policy on 1 October, and it was an annual policy because we've paid an annual premium. So that means it's going to run from 1 October until 30 September next year. This is February 2014, so it's going to run till 30 September 2015. Is that right? No, that's not right. That should be 2014. Okay, so now they say we've paid 8,880, but that relates to this period. So how much of this period relates to my financial year? Only this section from 1 October till 28 February. Because the question we're trying to answer is how much of this insurance that we've paid have we actually used in the current financial year? That's the accrual principle. How much have we actually incurred in the current financial year? In other words, how much have we used in the current financial year? Because whatever we've used, we need to pay for and record in our books in the current financial year. And we've only used this section here between 1 October and 28 February. So how many months is that? Let's count. October, November, that's 2, 3, December, January is 4, February 5. So that's 5 months. Okay, so we've got 5 months that relates to the financial year, and we've got 7 months that relates to next year. Okay, so this 8,880 is the annual premium. How do we know that? It said here, the annual premium of 8,880 was paid. So if that's the annual premium, what is the monthly amount? Divided by 12, that's going to give us the monthly amount. We want the amount for 5 months. Okay, so insurance incurred equals that times 5, 3,700, right? But now, let's have a look at the information. It says we've paid 8,880. Let's look at our trial balance to see if there's any information there. There we've got insurance 14,760. So that means this was not the only insurance that we had. And we know that because I said additional insurance was taken out. Right? So this 8,880 would be part of this 14,760. But 7 months of this insurance does actually not relate to this financial year. So 7 months insurance is prepaid. So prepaid insurance is actually going to be, we actually didn't need to calculate this, but prepaid insurance is going to be 8,880 divided by 12 to get the insurance for 1 month. 7 months is prepaid, and that's going to give us 5,180. Right, so 5,180 has been prepaid. We know this information has already been taken into account in the income statement. The journal entry for this would have been debit prepaid expense and credit insurance, because our insurance was actually too much. So we would have reduced our insurance in the income statement, right, if we were asked to do that. But now we're only asked the balance sheet, and they say this has already been taken into account in the income statement, so that's fine. So this leg has been done, but we need to record this in the note and in the balance sheet. So if we go to our trade and other receivables note, calculation E, oops, went too far there. Calculation E, amount is 5,180. And we can fill that in there. 100%. Good. Now, let's go back to our information here. We've dealt with this point as well. The provision for bad debts was adjusted to 5% of the debtor's control. So let's have a look at our trial balance just to see what the situation is currently. Before any adjustments, debtor's control is 64,000. We didn't have any bad debts. Normally we have to check first, was there any bad debts? There was no bad debts. So this is the balance that we're going to work on. Right? 64,000 Rand. Now we need to check, is there a provision for bad debts balance in the trial balance?
No.
We don't see any. That means the balance is 0. Okay, so I'm just going to do the calculation here at the bottom. Calculation F. We calculate what the provision for bad debts should be. Provision for bad debts should be, and we're going to calculate that. Provision for bad debts is currently, and the difference is going to be our adjustment. The provision for bad debts currently is a What is the amount current? Okay, when you look at our trial balance, there's no provision for bad debts. So we put this as 0. I'm just showing you for completeness sake if you had a question where there was a balance, right? And this would have been a credit balance. Okay, but it's now 0, so it's neither. Now the provision for bad debts should be, and they tell us, it should be 5% of the debtor's control balance. And we know debtor's control is 64,000. So it should be 64,000 minus if we had any bad debts, but we didn't have any bad debts. So that's 0. Okay. And we're going to multiply this by 0, not 0,5, that's 50%, 0,05. Please don't make that mistake. 0,05, and that's going to give us 3,200 credit. So to go from what it is currently 0 to 3,200 credit, we need to pass an adjustment of 3,200 as a credit to the provision for bad debts in the balance sheet. Right, so this one is going to be 3,200. What does provision for bad debts do to my debtor's control? It decreases my debtor's control. Alright, the other leg of this transaction would have been provision. So that's the credit. Provision for bad debts. Adjustment would have been a debit in the income statement. Okay. But again, we were told all of this information was taken into account. Because it's a debit in the income statement, that would have meant it was an expense. Right. Now we can work out our net trade debtors, and you work that out at 6,800. There we go. Let's go back to our information and see that we've handled everything. We've handled the provision for bad debts. Last one here, audit fees of 8,500 was still outstanding on 28th February. So that means, what is audit fees? It's an expense. Have we paid it? So what do we need to do with that expense? We owe that expense. We know, so that means we don't have that expense in our records. And we can see that, because if you look at your pre-adjustment trial balance, you don't see any amount for audit fees. Okay. So we know that this is just an extract of the pre-adjustment trial balance, but even if you had the full one, you probably wouldn't have seen an amount for audit fees. Okay, so we need to accrue for those audit fees. Means we need to account for them. Okay, so if we were asked the income statement, we would have had to put that audit fees in the income statement as in?
Expense operating expense.
Yes, exactly. Right, now we just asked the balance sheet, so where is this going to go? We owe money to the auditor. Where is that going to go?
Current liability.
Yes, the current liabilities. Under trade and other payables, we can add 8,500 audit fees accrued. 100%. Happiness. Right. Let's see. Now we've dealt with that. And information number G we used in the income statement already. Doesn't have any impact on the balance sheet or the notes. So we've dealt with all the additional information except our pre-adjustment trial balance, which would have a lot of easy marks for us. Okay, so we've already got the 2.4 in. We've got the 244,000. We've already included that. The loan we've also already included. You'll remember we've got the loan here. There's our 170. Okay. Our fixed assets, 2260. Where does that need to go?
Under non-current liability.
Yes, fixed assets. Money for jam. This is easy marks. 2260. We know there's no adjustments because we've already gone through all of them. Okay. You could go and grab these easy marks right up front of the question. Alright, where you put down the format of this balance sheet and you start filling in the easy marks. Okay. Alright, let's go back. So we've dealt with the fixed assets. Trading stock 162220. Where does that go?
Under current
balance sheet under current assets. We fill in inventory. 16, well, we don't know, maybe there's other inventory. So let's just say 162220. There probably isn't, but just in case, there might be consumable stores on hand or stationery on hand. Right, so we tick that one off. Debtors control 64,000. We've dealt with that one. Fixed deposit 125,000. Non-current assets. Okay, they don't tell us anything, so we assume the whole thing is non-current financial asset, and that is going to be 125,000 rand. And now we can fill in our total non-current assets. Fill in the total of 2385000. Right, let's continue. So this is easy marks, eh? Bank 170,400. Right, that is going to be part of my current assets.
Cash and cash.
Yes, cash and cash equivalents. And we've got here 170,400. Right, there's one piece of information that we did forget to deal with, and that was this point number B, the share buyback. They said this transaction was not taken into account in the pre-adjustment trial balance. That means we bought back the shares for 95,000 rand, but we never accounted for that. So this amount should actually be 95,000 rand less. So we're going to show that also in our calculation here. Minus 95,000 rand. Happiness. Right. Now we can tick it off. Creditors control. What are we going to do with that? Liabilities or asset? It's a liability. It's a current liability. Go to our current liabilities.
Bank overdraft.
Plus 34,000 rand. Right, let's tick it off. Insurance, we've dealt with that already. It was part of the income statement. Rent income was part of the income statement. Interest on fixed deposit was part of the income statement. We've dealt with that. Total other operating income statement. Ordinary dividends was part of the retained income note. All of these incomes and expenses will eventually be closed off and included with my net profit in the retained income figure, which we have done already. Here we go. Here they are in my retained income, net profit, and the dividends. Okay, so we've dealt with all the information. So all we have to do now is to make sure we've put down all our totals and transfer all the note totals to the balance sheet when needed. So let's go back up. Start at the beginning. We've done the income statement. We've transferred this net profit to, where is my cursor? To the retained income. So that's done. Debtors control. We can complete this. 5180. There was nothing else. 8,200. We can fill in the total. That's going to come to 80,060. This is going to go to the balance sheet under my assets, and specifically my current assets, under a line item called trade and other receivables. Right, folks, doing wonderful here. I hope you're still with me there at home. Balance sheet, trade and other receivables. And we fill that in here. 80,060, and we can refer back to our note. And that was note 5.2.1. Okay, that's good. Inventory we can fill in now because we didn't have any other inventory. Cash and cash equivalents we can fill in 75,400. And we can total our current assets. It comes to 311,800. Actually, trade and other receivables. No, that was correct. Right, we can total our shareholders' equity. That comes to 2581250. We can total our loan. That's going to come to 152,000. Am I correct? I hope so. We can total our short-term portion. That was only the 35,000. Trade and other payables. If we add this up, let's quickly do that. 196,250. You could have split out the shareholders for dividends if you wanted to and have a separate line item. Right, if you then total your current liabilities, this comes to 231,250. Total equity and liabilities then comes to 2,964,500. We're supposed, well, let's add up our total assets as well. If you just add up these amounts, you already get a easy money for jam mark. So please don't forget to add up. Even if you didn't do the question, put in some figures and add them together, because you're going to get easy marks just for putting the totals. Okay, so that's money for jam. So get them. Right. Don't worry if you don't balance. Right? That's not the end of the world. In this case, the reason we also don't balance is because there was a mistake in the question and the retained income opening balance was actually incorrect. So don't make that your main aim to try and balance. As long as you've dealt with each piece of information, as you go through the information, make sure you deal with both legs of the transaction. For example, this one, number B, it affected the bank and it affected the equity. The dividends affects the equity. Where's the dividends? It affects the equity and it also affects my liability. If the income statement was asked, all of these items would affect the income statement item and the balance sheet and possibly also the notes. Right, that was question 5. The theory, you can look through the memo for an answer on the theory. I'm not going to go through that right now. Thank you.